Investors have long been taught to believe that wealth is earned through cleverness, timing, or risk-taking. From the moment you step into the world of finance, you are bombarded with flashy headlines, stock tips whispered in trading rooms, and the constant siren call of the next big thing. Our instincts, honed over millennia to favor immediate reward and tangible gains, tell us that slow accumulation is inferior. But the reality, as decades of market history reveal, is profoundly different. True wealth is rarely spectacular, rarely newsworthy, and almost never built overnight. It is the quiet result of consistent decisions, compounded over time, and shielded from the emotional storms that overwhelm most investors. The system that allows this is elegantly simple: dollar-cost averaging into broad market index funds. This approach transforms the human weakness for impatience into a disciplined advantage, making the ordinary investor the unlikely hero of their own financial story. Consider the very nature of human behavior and markets. When prices rise, the instinct to join the crowd is overwhelming. When prices fall, fear triggers the desire to flee. This oscillation between greed and fear is not just anecdotal. It is the dominant narrative throughout modern financial history. From the market panic of 1929 to the tech bubble of 1999 and the financial crisis of 2008, investors consistently fail not because they lack intelligence, but because the market preys on predictable human emotions. Here is where dollar-cost averaging offers its quiet magic. By investing a fixed amount at regular intervals, regardless of market conditions, you remove the influence of timing and emotion. You buy more shares when prices are low and fewer when prices are high, a principle that seems almost too obvious to matter, but its effect over decades is profound. The genius of this approach is that it requires no forecasting, no speculation, and no heroics. It requires only consistency. Let us examine the mathematics of compounding in a way that ordinary investors can grasp. Suppose you invest $100 every week into a diversified index fund with an average long-term return of 7% annually. You do not try to pick the peaks or avoid the troughs. You do not switch strategies when headlines scream. After 10 years, those weekly contributions grow substantially, not because of any magical timing, but because each contribution has had the chance to grow at market rates, and each low point in the market allowed you to purchase more shares at a lower price. Over 20 years, the result is exponentially larger. Over 30 years, a seemingly modest and repetitive habit transforms into a nest egg sufficient to change your life. This is not theory. This is observed reality in the historical data of the S&P 500, the total stock market, and similar broad indices. Investors who embrace this principle tend to accumulate far more wealth than those chasing short-term gains, despite the appeal of momentary excitement. Dollar-cost averaging is also a profound lesson in humility and patience. Unlike stock picking, where ego, pride, and overconfidence can wreak havoc, investing systematically through index funds asks nothing of you but discipline. The market does not reward cleverness in the short term. In fact, most clever attempts to outsmart the market result in subpar returns. This was John Bogle's enduring insight. The most important factor in long-term investing is not selecting the right stocks or funds, but minimizing costs and staying the course. High fees, frequent trading, and reactive decision-making erode returns faster than any market crash. The ordinary investor, disciplined in contribution and patient in expectation, benefits not from luck, but from a compounding of small, intelligent choices repeated relentlessly over decades. History offers vivid examples. During the 1970s, for instance, the United States experienced stagflation, high inflation combined with stagnant growth. Many investors panicked, selling in fear, attempting to time a volatile and unforgiving market. Those who persisted in regular contributions to broad market funds weathered the storm and eventually participated in the rebound, demonstrating that the combination of time and discipline consistently overcomes volatility. Similarly, the tech bubble that peaked in 1999 saw exuberant investors reach for extraordinary gains, only to suffer dramatic losses when the bubble burst. Yet those who continued their regular contributions to diversified funds, ignoring the mania, emerged decades later far wealthier than the most aggressive speculators. The lesson is clear. Market cycles are inevitable, but disciplined, consistent investing navigates them with far greater reliability than any attempt at cleverness. There is also a psychological benefit embedded in this strategy. By committing to a system, you remove the constant stress of decision-making from your life. You are no longer hostage to market noise, the headlines, or the well-intentioned advice of friends and pundits. The simple act of regular investing trains the mind to accept volatility as normal and to understand that wealth is built over decades, not weeks or months. Every contribution, every purchase of shares is a vote for your financial future, a tangible action that reinforces patience and discipline. Over time, you internalize a quiet confidence that comes not from predicting the market, but from trusting a process that history validates repeatedly. Furthermore, dollar-cost averaging demonstrates the power of ordinary consistency. The story of wealth accumulation is rarely dramatic. It does not require genius or extraordinary insight. It asks only that you start, persist, and avoid interference with your own progress. Small amounts invested regularly grow into sums that are difficult to imagine from the vantage point of a single day. The ordinary investor who embraces this practice for decades discovers that what feels insignificant at the moment, $100 here, $200 there, is, in fact, the bedrock of extraordinary outcomes. The quiet accumulation, almost invisible in daily life, produces results that astonish even the disciplined observer once sufficient time has passed. Finally, the philosophical elegance of this approach lies in its alignment with human nature, not against it. Instead of attempting to outthink the market or defy instinct, it channels human weakness into advantage. Our impatience and anxiety are neutralized by a system that buys in good times and bad, that ignores temptation and focuses on persistence. Wealth is no longer a prize reserved for the clever, the lucky, or the audacious. It becomes accessible to anyone willing to adopt simplicity, patience, and discipline. The beauty of dollar-cost averaging is that it transforms what feels like ordinary, repetitive behavior into extraordinary results over decades, a triumph of consistency over brilliance. As the principles of dollar-cost averaging become clearer, it is instructive to examine how they have played out in actual market history. Consider the 1999 tech bubble once more. At the peak of the dot-com craze, companies with no profits, no revenue, and sometimes no product were valued at tens of billions of dollars. The media glorified these meteoric rises, and investors, ordinary people and professionals alike, felt compelled to participate. Many bought at the top, riding the hype in the hope of instant wealth. Within a few years, the bubble burst, erasing trillions in paper wealth, devastating retirement accounts, and leaving countless investors disillusioned. Yet those who had committed to regular contributions in diversified index funds, unfazed by market euphoria, continued to buy shares at elevated prices and, crucially, also during the inevitable declines. 20 years later, these same disciplined investors enjoyed wealth that far exceeded the apparent winners of the mania, simply because they had remained patient and consistent. Historical examples like this highlight a critical truth about human behavior. Intelligence does not inoculate against predictable financial mistakes. Even well-informed, rational individuals are prone to overreact to fear and greed. Behavioral finance has demonstrated repeatedly that investors tend to buy high in moments of excitement and sell low when panic strikes. This is not a failing of knowledge. It is a flaw rooted in our psychology. Dollar-cost averaging neutralizes this flaw by creating a mechanical, emotion-resistant framework. By contributing a fixed amount at regular intervals, the investor buys more shares when prices are depressed and fewer when prices rise, naturally benefiting from market volatility. The system leverages a behavior that would otherwise be destructive volatility itself to the advantage of the disciplined investor. To put this into perspective, imagine an investor contributing $200 per week to a broad market index fund over a period of 30 years. During market booms, those $200 buy fewer shares, which may feel unsatisfying at the moment, but prevents overexposure at inflated valuations. During market downturns, the same $200 buys substantially more shares, setting the stage for larger growth as markets recover. The result is a smooth trajectory of wealth accumulation that bypasses the highs and lows of emotional investing. By the end of 30 years, the portfolio will have compounded dramatically, not because the investor made brilliant predictions, but because a simple, disciplined routine allowed the mathematics of compounding to operate unimpeded. Another compelling illustration comes from the aftermath of the 2008 financial crisis. The stock market plummeted nearly 50% from its previous peak. Investors who panicked and withdrew their funds locked in devastating losses, while others froze, paralyzed by fear. Those who maintained their dollar-cost averaging schedules continued to invest steadily. Within a few years, not only did the market recover, but those investors had purchased additional shares at depressed prices, accelerating their long-term growth. In effect, the market's volatility became a gift for those with discipline. This pattern repeats across decades. Downturns create opportunities for the consistent investor, while the impulsive, reactive investor suffers disproportionately. It is also important to recognize the compounding effect of time itself. Many investors underestimate the exponential power of long-term investing, assuming that short-term gains are what matter most. Yet, compounding operates silently, multiplying modest contributions into substantial wealth over decades. An investor contributing consistently for 40 years, even at moderate amounts, will see growth that outpaces the frantic gains of the most active traders over the same period. The ordinary, patient investor, leveraging time, discipline, and low costs, often achieves results that appear extraordinary in hindsight. This is the essence of the Bogle philosophy. Success comes from minimizing costs, maximizing time, and trusting a simple, proven process. Behavioral science helps explain why such a simple system is so counterintuitive. Humans are drawn to narratives of heroism and brilliance, believing that wealth is earned through daring moves, clever timing, or extraordinary insight. Yet empirical evidence repeatedly shows that these narratives are illusions. The majority of active investors, including professionals managing large funds, fail to outperform broad market indices over decades. The irony is that what feels boring systematic contributions to a diversified low-cost index fund is, in fact, the strategy most likely to succeed. This inversion challenges our intuition but reflects reality. The market rewards patience and punishes hubris. Recognizing this gap between instinct and reality is the first step toward financial mastery. The implications for daily financial life are profound. Dollar-cost averaging requires minimal mental bandwidth and reduces anxiety, allowing the investor to live fully without obsessing over daily market fluctuations. It aligns with ordinary human schedules. Weekly or monthly contributions can be automated, eliminating the temptation to speculate or time trades. Furthermore, it emphasizes consistency over precision. An investor need not worry about perfect timing or market prediction, only about maintaining the habit. Over years and decades, this habit compounds into meaningful wealth, demonstrating that small, regular actions consistently applied have far more impact than sporadic bursts of cleverness or luck. Yet the strategy's power is amplified when combined with low-cost index funds. Fees, however small, erode returns significantly over decades. Bogle's insight was revolutionary in its simplicity. Investors cannot control market returns, but they can control costs. Choosing low-cost funds, maintaining a steady investment rhythm, and ignoring short-term volatility creates a framework where compounding operates with minimal friction. The combination of disciplined contributions and cost efficiency is what turns ordinary investment behavior into extraordinary wealth accumulation. This is a principle that transcends markets, cycles, and trends. It is a timeless strategy validated repeatedly over nearly a century of financial history. Ultimately, the lesson for the ordinary investor is that financial success is not about brilliance, luck, or timing. It is about constructing a framework that accommodates human psychology, leverages time, and minimizes costs. Dollar-cost averaging into broad index funds embodies this philosophy. It turns volatility into opportunity, impatience into advantage, and the quiet accumulation of small, consistent contributions into a life-altering outcome. By understanding this, investors are empowered not just to grow wealth, but to do so in a manner that is psychologically sustainable and profoundly effective. In this way, the ordinary becomes extraordinary, and the slow, deliberate path reveals itself as the true wealth machine. The most common objection to dollar-cost averaging and index fund investing is almost always rooted in the seductive allure of outperformance. Why settle for average returns when I could pick the next Amazon or Tesla? Investors ask themselves. The question feels natural, even rational, because our culture glorifies risk-taking, rewards hero narratives, and equates extraordinary wealth with extraordinary insight. Yet this objection overlooks a crucial fact. The vast majority of active investors, including highly skilled professionals, fail to beat the market over long horizons. Historical data, including the studies of large mutual fund returns across decades, consistently demonstrate that market-beating strategies are rare, fleeting, and often the product of luck rather than skill. When confronted with the possibility of underperformance, many investors feel anxious, fearing they are missing out on gains while others succeed. This fear is potent because it appeals directly to our social instincts and our natural aversion to regret. It is precisely the psychological pressure that leads to impulsive trading, timing mistakes, and financial loss. To engage this objection fully, it is essential to examine not only the logic of long-term investing, but also the human stories that bring the stakes to life. Consider a couple in their early 40s who, swept up in media hype, shifted substantial savings into high-flying tech stocks at the height of the 1999 bubble. Their friends praised their courage, yet the crash was catastrophic. They watched their retirement savings halve in less than 2 years, their confidence shattered, and their financial stress amplified. Meanwhile, a neighbor of similar means and ambition, investing steadily in low-cost index funds through dollar-cost averaging, experienced no such trauma. Their portfolio endured the same market swings but continued to grow quietly, steadily over the years. By the time the market recovered and surpassed its previous peaks, the disciplined investor was far ahead, not because they were cleverer, but because they had avoided the emotional trap of overconfidence and timing. This contrast illustrates the core lesson. Trying to outperform the market is psychologically and practically hazardous, while following a disciplined, systematic approach consistently yields superior results. This objection also highlights an important emotional dimension, the tension between fear and desire. Investors fear missing out on spectacular gains, but they also fear loss. The intelligent mind struggles to reconcile these contradictory impulses, often resulting in paralysis or reactive behavior. Dollar-cost averaging addresses both fears simultaneously. By committing to regular contributions, the investor participates fully in market growth without risking catastrophic exposure or succumbing to impulsive decisions. When the market surges, they continue to invest steadily, contributing less per unit but maintaining their trajectory. When the market declines, their contributions buy more shares at lower prices, transforming fear into an advantage. Over decades, this disciplined approach compounds into wealth far exceeding the outcomes of sporadic, emotion-driven attempts at outperformance. There is a profound human story embedded in this framework. Consider the experience of a young professional starting their first career in the mid-2000s, contributing modestly each month to a diversified index fund. Initially, the portfolio seems inconsequential, invisible against daily expenses, and the temptation to chase high returns is ever present. Yet, year by year, contributions accumulate, dividends reinvest, and the portfolio grows steadily. By the time the investor reaches middle age, the cumulative impact is enormous, dwarfing any short-term gains they might have sought through speculation. This narrative illustrates the transformative power of patience, consistency, and humility. The lesson extends beyond finances. Disciplined action, compounded over time, yields extraordinary results in ways that instantaneous decisions and clever maneuvers cannot replicate. Another counterargument arises from the perception that dollar-cost averaging is too boring or lacks excitement. Modern culture equates risk with reward and dramatizes wealth creation as a thrilling pursuit of the extraordinary. Yet the history of markets and the biographies of legendary investors such as Warren Buffett and John Bogle reveal that sustainable wealth is almost always the product of ordinary, repetitive behavior executed with excellence and consistency. The very quality of being boring, the absence of drama, the rejection of hype, is what allows disciplined investing to succeed. In a market environment designed to exploit impulsive behavior, restraint becomes a competitive advantage. The so-called dull path is paradoxically the most potent route to financial freedom. Emotionally, addressing objections in this way helps the investor confront the discomfort of surrendering the illusion of control. Human beings have a natural desire to feel responsible for extraordinary outcomes, to believe that brilliance or intuition drives success. Dollar-cost averaging asks them to release that illusion, to accept that long-term, consistent action trumps short-term genius. This surrender is not weakness, but empowerment. It aligns behavior with historical reality, psychological insight, and practical simplicity. By internalizing this truth, investors gain both clarity and peace of mind, freeing themselves from the anxiety and regret that ensnare so many others. Moreover, the objection that I could make more by timing the market fails to account for the compounding power of time. Every day, week, and month that the disciplined investor contributes systematically strengthens the portfolio's growth trajectory. Missed contributions or emotional withdrawals erode this compounding advantage more than any hypothetical misstep in timing could. Over decades, the impact of consistent contributions far outweighs the occasional windfall from a correctly timed speculative bet. The narrative of lost opportunity diminishes in significance when measured against the steady accumulation of wealth through predictable, repeatable, and historically validated strategies. Finally, confronting objections provides an opportunity to highlight transformation. The investor who embraces the discipline of dollar-cost averaging and index fund investing experiences a profound shift, not only in portfolio value, but in mindset. Market volatility no longer triggers panic. Headlines no longer provoke impulsive reactions. Instead, the investor observes, contributes, and allows time to work its compounding magic. This transformation is not abstract. It manifests in the confidence, patience, and psychological resilience cultivated through years of consistent practice. The ordinary investor becomes, quietly and inexorably, the master of their financial destiny, unshaken by the chaos that engulfs those who pursue excitement over consistency. As the emotional core settles, the conversation naturally moves from philosophy to practical clarity. The beauty of dollar-cost averaging into low-cost index funds is that it does not require extraordinary effort, meticulous research, or complex calculations. Yet within this simplicity lies a profound behavioral principle. The consistent act of investing, even in modest amounts, accumulates extraordinary outcomes over decades. Consider an ordinary individual contributing $100 weekly to a broad index fund starting at age 25. By age 65, with a reasonable long-term annual growth of 7%, the portfolio has grown to a sum that transforms the individual's retirement security. The contributions themselves were modest, almost unremarkable in daily life, yet the compounded growth has created real financial independence. It is a lesson in the quiet power of repetition and time, illustrating that wealth is often the result of habitual choices rather than brilliance or luck. This perspective reframes what many perceive as boring investing into an extraordinary advantage. While headlines chase sensational returns and social media amplify speculation, the disciplined investor is quietly building real wealth. The repetition of contributions, the reinvestment of dividends, and the steadfast avoidance of unnecessary fees combine to amplify compounding, creating a trajectory few would have predicted at the outset. The principle here is elegantly simple. Over the long run, consistency outperforms cleverness, and restraint outperforms impulsive action. In other words, what feels ordinary on a daily basis is, in reality, the most powerful lever for long-term financial success. In practical terms, this translates to designing a financial life that aligns naturally with human behavior. Automating contributions, whether weekly, biweekly, or monthly, removes the temptation to procrastinate or speculate. Low-cost index funds reduce friction, ensuring that compounding operates efficiently. Over decades, small decisions, regular contributions, dividend reinvestment, avoiding high fees accumulate into enormous advantage. The behavioral insight is that humans often fail to act consistently due to distraction, emotional swings, or perceived complexity. By simplifying the process and embedding it into the rhythm of daily life, the investor removes these psychological obstacles. What remains is a straightforward, replicable path to building wealth that does not rely on luck, timing, or heroics. There is also an overlooked cognitive reframing that reinforces commitment. Investors often fixate on absolute returns or short-term gains, leading to disappointment and impulsive shifts. By focusing instead on the process contributions, reinvestment, and patience, the investor experiences a sense of control and satisfaction independent of market fluctuations. Each regular investment becomes a tangible action, reinforcing financial agency, a concrete step toward long-term goals. Over time, this process-oriented perspective nurtures a mindset resilient to fear, excitement, and market hype. It is a subtle, yet profoundly impactful shift. The investor measures success by discipline and consistency rather than by fluctuating market outcomes. A surprising insight emerges when we consider volatility in this framework. Market swings, often feared by ordinary investors, are transformed into opportunity. Dollar-cost averaging allows the investor to purchase more shares when prices are low and fewer when prices are high. This naturally harnesses volatility to the investor's advantage. Rather than being a threat, fluctuations become a mechanism for enhancing returns. In contrast, those who attempt to time the market or chase gains often amplify their risk exposure, buying high and selling low, and ultimately undermining their own wealth accumulation. The ordinary investor, by remaining consistent and disciplined, converts what others perceive as danger into a powerful advantage. At this juncture, many people experience a quiet revelation. Wealth need not be dramatic, sensational, or high risk. It can be methodical, deliberate, and patient. By embracing simplicity, minimizing costs, and allowing time to compound contributions, ordinary investors consistently achieve outcomes that would astonish anyone expecting wealth to arise from brilliance alone. It is a paradigm shift. Investing is not a contest of cleverness, but a test of patience, discipline, and adherence to proven principles. This realization transforms the way one thinks about financial planning, daily decision-making, and even personal ambition. The mundane act of contributing steadily becomes a potent demonstration of foresight, intelligence, and self-mastery. Consider the psychological reinforcement of visible progress over time. While the early years of investing may feel imperceptible, as contributions accumulate and compounding takes effect, the portfolio eventually reaches a stage where growth becomes exponential. This reinforces the habit, builds confidence, and strengthens commitment to the process. Investors learn to trust the system rather than rely on intuition or speculation. The boring behavior of regular investing gains emotional resonance as it produces tangible, cumulative results. This phenomenon exemplifies the intersection of behavioral finance and historical evidence. Consistent action over decades creates the conditions for extraordinary outcomes without the need for heroics or high-risk gambles. A mid-script reframe reinforces engagement. The very discipline that feels restrictive or dull is, paradoxically, what makes investing powerful. Unlike speculative trading, which rewards ego, impulsivity, and luck, the systematic investor is guided by principles that compound silently over time. The ordinary act of investing becomes a form of leverage far more reliable than any market timing or stock-picking scheme. This reframing not only captures attention, but subtly shifts the viewer's perception of effort, risk, and reward. What once seemed boring is now revealed as the most strategic and effective path to wealth. Finally, this section closes by reminding the viewer that practical clarity is inseparable from historical evidence. Decades of market data confirm that those who adhere to low-cost index funds consistently contribute and allow time to compound far outperform the majority of active investors who chase short-term returns. This is a principle not contingent on market predictions, economic forecasts, or exceptional skill. It is a universal truth validated repeatedly by history. By internalizing this understanding, the investor gains both the mental framework and the practical discipline to navigate life's financial decisions with confidence, patience, and clarity. Wealth, after all, is not an accident of timing, but the outcome of deliberate, consistent, and intelligent behavior sustained over decades.